Okay.
No.
We are live with Daniel Patton. I was going to say Super Bowl champ, Dan Patton, and Lorenzo Podda.
Hey, I'll take it.
Yeah, we know Kansas City won. Listen, we just talked about it. If the Leafs ever win, I guess you're not being insufferable. Is that the word? Insufferable?
Yeah. I think so. Depends on how you're using it.
Yeah, well, I'm using it like you are behaving. So you are just basking. You have a Super Bowl glow to you.
I do.
So anyone who doesn't know, Kansas City won the Super Bowl. Dan's a long-time KC fan, and that's all we have to talk about there.
And I always have to preface that with I'm probably the biggest Mahomes fan there is, but I was a longtime Chiefs fan before Patrick.
How did you become a Chiefs fan?
When I was a kid, do you remember Sega Genesis?
Yeah.
So they sports talk football. Joe Montana went to Kansas City.
I wasn't a Sega guy. I was a Nintendo. So I don't know if maybe I didn't have that.
So I was always Kansas City. And I was actually, I would never, I shouldn't say, I was just going to say, I never admit this, but here we are live on air. I used to be a Bills fan. And then when they lost the 4 straight Super Bowls, I was like,
well, that did it to all of us. I didn't pay attention for about 15 years after that.
That's it. I need a new team. I can't.
My low point was when Thurman Thomas couldn't find his helmet at the sidelines. I don't know if you remember that.
Oh, yeah.
But I think I just threw my hands up and like this.
They said it would have been a touchdown. The ESPN did a really good documentary on their 4 straight Super Bowl losses. They highlighted. Yeah, it was really good. They highlighted that.
I can't watch that stuff. We were just talking about the mortgage stuff that's kind of hit the news a little bit. I can't watch when people break it down because I guess it's kind of like watching a car crash.
Yeah.
Like I don't want to
what's going to happen.
Yeah. And I want to ask you guys about the mortgage stuff in the news right now, but let's just, I want to kick off with some, kind of high level mortgage stuff. BMO is in the mortgage broker channel.
Yes.
So what does that mean to you guys? So for anyone listening who's a real estate investor, what does that mean?
So it's really cool actually. So for a lot of years, there was only traditionally 2 banks that really dealt with mortgage brokers in TD and Scotiabank. And the past couple of years, some banks started coming in the channel. We've gained access to a couple other lenders that most brokers don't have access to, which is cool for us. And then BMO announced that they were coming into the broker channel as well. So that is something very welcomed for us because now it just gives us as the broker access to another big bank. They announced it. They're starting off with 100 brokers. We're 5 basically of the 100 that get to use BMO. So our launch date is this week. So it's great for investors. We've seen a lot of their product right now. And so a lot of it's really good for investors, especially the ones starting off buying the first 5 or so properties. Their underwriting guidelines and the rules they have are really good. Rates seem pretty competitive as well. So yeah, it's going to be pretty exciting.
And does BMO still have that high? I always remember they had a high net worth program where you could qualify with net worth only. Is that accurate? Or?
Yeah, they still have the program for the net worth. A lot of the banks adopted a net worth program now too. So
Royal Bank has one.
Yeah,
that's
RBC,
everywhere now.
Scotia has one. Yeah, so a lot of banks have that. BMO's got some really cool stuff for new constructions as well. Well, they'll actually loan on appraised value versus the purchase price of the property. So if you bought a place 3 or 4 years ago, it might be worth $100,000 more now. They'll give you a loan based on what the appraisal comes in at versus the purchase price. So a lot of people want to take advantage of something like that. But yeah, they got a couple of cool programs, so we're really excited for it.
And then what else is going on? The MLI program is that still popular? I'm only hesitating because when a program gets really popular, I always am suspicious and think, I don't know if this is a CMHC program. I'm always thinking, does CMHC just pull the plug on this program? But maybe it doesn't. Can you describe the program first of all?
I'll leave it to Lorenzo.
Okay, Lorenzo. Yeah, map it out.
No problem. Basically, it's a program CMHC put in place, and essentially it allows someone who's buying a property or refinancing to get up to 95% loan to value on the property. And you can get as long as a 50-year amortization. And so to qualify for that, obviously the normal qualification applies in terms of debt servicing on the property. But the other biggest things, they have 3 factors that they look at. And so one of them is called accessibility. The second one is called energy efficiency. And then the third one is affordable rents. So essentially it's all a scoring system. So we could probably even put up a chart for it if someone's watching. But essentially it's based on a scoring system. So if you get up to 100 points on those 3 factors, you can then get up to 95% loan to value and 50-year amortization. So it's helped a lot of people with their numbers, especially with purchase prices going up, interest rates starting to climb. Being able to extend that amortization has been helped a lot of people be able to qualify for these properties and cash flow.
So can you give an example? Where do you have a client that is using it in some capacity?
Yeah,
so someone could picture what is happening here.
Yeah, absolutely. So we got a lot of people. So for example, new constructions are big. So we'll have people buying a plot of land. They'll turn around, they'll go and build call it for $1 million, whatever that number will be. They'll build a property, build to the specifications for, let's say, the energy efficiency.
What type of property?
6-plex, 5-plex, 10-plex. So anything.
At least a 5-plex.
Yeah, at least a 5-plex, any multifamily. You are allowed to have a little bit of commercial, like actual commercial units in there as well, but there's specifications on that. But yeah, basically it's anyone come build a property. They will build the energy efficiency basically toward a maximum you get is 40%, basically more efficient than what the standard for Canada is. And that'll get you the 100 points. They can then get their financing, obviously as long as their debt servicing works, they can get their financing up to 95% loan to value, 50-year amortization. So a lot of stuff, it's on renovations too. We're seeing a lot of that as well. So people buying a property, fixing it up, renovating it, doing it toward those specifications for the MLI Select, and then being able to get financing based off of it. The affordable.
So the better financing is allowing them to extract equity out of the property.
Extract equity, and the biggest thing is cash flow as well. To be honest with you.
And when you're comparing it to residential real estate, very different, right? Residential real estate is all about 20% down, 30-year amortizations. This is an alternative to that. When you're trying to buy rental property, especially in Southern Ontario these days, hard to cash flow. So an alternative to that has been the MLI. I think that's why it's picked up a ton of steam, because investors are seeing, well, with this, I can get up to 95% financing, which is in residential, you can't get that unless you're buying an owner-occupied home. 50-year amortizations, to Lorenzo's point, keeps those payments low. So you're going to be able to cash flow. Whereas, these days, maybe a duplex, triplex, you can cash flow, but single family is going to be tough. So more units, more rent, longer amortizations, lower payments. That's what's making it more attractive and sort of funneling this. Plus, it's new. It came out in 2022, I think.
I think 2021
or 2022 is when it came out. So it's relatively new, and everybody loves the shiny new toy.
Everybody does. I feel like it's the new Burr.
Burr
came out.
Yeah, 100%. And which Burr can still be valuable to the right investor. You get the right opportunity. It's a tool in your sort of arsenal of investment.
And I'm half joking when I say Burr, because I laugh at that one specifically, because all it was buying a property and doing something to it and then refinancing it. But it was put into an acronym, and everyone, and
it's all marketable.
It was just a marketable kind of thing that everyone sort of jumped on.
Well, and in a market where properties are going up 20% per year, it makes a lot of sense. You can get that money back out, reno it. It's going up in such insane values.
And the tide's coming out right now, which I'm going to talk to you guys about what some of the stuff you're seeing. But okay, so the MLI program, MLI Select.
Correct. It's called MLI Select.
MLI Select CMHC program. Yep. And what you're describing is a lot of people are hitting the energy efficiency points, but there is that one where some people are hitting the rent or the affordable rent. Can you just talk about that a little bit more?
Yeah, absolutely. So the affordable rents is basically CMHC came out with a guideline for every region, city, town, and in Canada, where what they think basically affordable amount, or they call it the median income that someone makes in that town. CMHC then for the MLI Select program then says if someone's rent is 30% of their income or less, so let's say you have someone makes $100,000, like a median income's $100,000 a year, they would say someone in that area should not pay more than $30,000 a year in rent. And so what they will say, if your units, let's say you have a 10-plex and 5 of the units are under $30,000 a year in rent, essentially, then they will give you points toward that MLI Select. Now, a lot of people don't go after that one necessarily because A, you're keeping your rents typically lower than market value, and B, they make you guarantee you have that low rent for at least 10 years. So it's tougher to cash flow when you have 6, 7 unit properties. I've seen them on multi-unit where it's 20 units and above, just because the economies of scale, the numbers still can sometimes work. But a lot of times that one's a tougher one for most investors to want it. Also because we've all seen rents start to increase like crazy. If you're purposely handicapping yourself in a sense and not being able to raise them, it becomes a challenge.
Yeah, got it. Okay.
Funny enough, the Burr is where you actually see a lot of the
You
MLI.
like the Burr too.
No, but for MLI, it does make a lot of sense, because the problem is, you're going to see more of them coming up, but the problem is a lot of the properties that are for sale, the multifamilies, weren't built to the specifics of this MLI program. So it's hard to qualify for that.
So describe what a Burr is. So now we've used the acronym. Just describe.
So Burr is BRRR, and then you can add another R if you want sometimes, but it's buy, renovate, refinance, repeat. That's the Burr, right? Buy, renovate, refinance, repeat.
Rent.
And then rent. Yeah, that's the R.
Don't forget one of the
rent.
R's, Dan.
Yeah, that's an important one too. The rents. That's an important one. But that's we see a lot of that with the MLI, because people are building the property to the specifics now of the MLI,
so that they get the 50-year amortization.
That's right.
They can refinance it back up to 95% loan to value, pull out the money that they've put in.
That's right.
So people are doing this.
There's a little caveats with that, obviously. So sometimes times if you're doing a full new construction, you can't just go 95 loan to value.
Yeah.
They'll make you go what's called loan to cost. So let's say to buy the land and to build costs you $1.5 million. Well, they're only going to give you, and you want to refinance it right away, they will give you 95% of your cost to complete all of that work. So there's little nuances with it, but obviously most people that build out kind of these investors kind of, I guess, what do you call them, perspectives or prospectuses, will show kind of ways after 5 years to be able to pull all the money back out at some point. But yes, the 95% loan to value or loan to cost, depending what you're doing.
Okay, so BMO new to the mortgage broker channel.
Yep.
Not to everyone, but
Correct.
you guys are on the list, so you're getting
Correct.
access to the BMO stuff. That makes everyone else more competitive too. No, I would just think Bank of Nova Scotia and TD all of a sudden are like, oh, geez.
You'd hope.
Yeah, okay, so too early to tell.
It definitely will. It's like start to kind of come. We'll see how obviously BMO does come in. Obviously, it's really exciting, the new shiny toy that everyone's going to be excited to use. So it's one of those things like wait 6 months, 7 months, see how it all plays out. But definitely going to bring more banks, more competition, which is good.
Yeah, we'll see what the market. I feel like the narrative on rate cuts this year is changing like weekly. Like 2 weeks ago, it was like, no, they're not going to cut. Then today, food inflation numbers came out.
Yeah.
They came out a little lower than people were expecting, and now everyone's like, oh, rate cuts might be back on the table. So I feel like we're in this weird spot. I think we get rate cuts sometime in the second quarter of this year.
How many do you think we get this year?
Oh man, I don't know. I just feel like the U.S. election is the variable.
Yeah.
Because if I wanted the incumbent to win, and there was political favoritism happening, if there was, I would start cutting.
Yeah.
Damn, why are
Rates.
you laughing when I say that?
Because you laughed.
Did I? What? There's politics involved in the central banking system? I would probably cut a couple rates in the spring. Like I would make a couple cuts, maybe by July. Now, saying that now seems like almost unbelievable to me, like 2 cuts before July, but I don't know. You would want the market to be just humming by the time the election comes, and you can't cut rate and get an instant response in the economy.
It'll take a couple months.
So I think 2 rate cuts by the summer are coming, and then this year maybe 3 or 4. Like if everyone's thinking 3, I immediately think it's not 3.
Yeah.
So it's either 0. It's either inflation does a U-turn right now, and we're like, holy shit, rates are going up.
Yeah.
Well, I don't know why I'm laughing on that, because that would just devastate everybody. Holy shit. Can you imagine if inflation just U-turned right now hard?
I think they'd have to just leave it though. Like,
I think they would just have to leave the whole economy and walk away from it all day.
no,
New system.
Close the door.
just leave I don't know. Like I've thought about that, obviously, because my opinion changes sometimes weekly.
Hourly?
Yeah. Like, I get asked, what's the best rate, to take? And it's like, I had an answer 6 months ago. That might've been different 3 months ago.
And today I feel like it's
today.
wild.
Yeah. It's very tough to pick a rate. So,
So what do you say? I'm saying 3 or 4 this year, but I hate that answer because I feel like so many people are saying 3.
Yeah.
So to me, it's less than 3 or more. And if I had to, it seems so wild. I guess I'm going more, but I'm hesitating as I say that because it seems crazy right now.
I think
because we're already late February.
I think but I mean, I have no real, information to say this, but
You don't have the bat phone to the
No,
Federal
I
Reserve?
wish I did, but I just wish, I just feel like they can't drop it too quick. And if they do, our economy's been doing pretty good right now, despite, the rates. So I just feel like if they drop it.
But is it doing good?
Well, I mean, job report was
I know, but that was all government jobs.
Yeah.
Like when you broke it down, it was like everyone's working for the government.
Yeah.
I think in the Soviet Union, a lot of people worked for the government.
Well, that's the argument. But, next year, to your point, if you're going to look at the politics side, next year makes the most sense for me in Canada. But it's got to be tied together, right? Well, not directly, but we don't fall too far behind the U.S. So I think more likely next year. But listen, half a point, I think, would be good. I think if we dropped half a point.
Yeah, 2 drops.
Yeah, 2 drops of a quarter point.
Okay, so you guys both 2 drops this year.
Well, I can see, and I can see sentiment already changing. Like we get the benefit of seeing it on the front lines. As soon as sentiment starts to change, the phone starts ringing. People market's picking up. We realtors are telling you hear it too. Multiple offer situation. So I feel like it's not it's not busy by any stretch, but it's getting busier. The sentiment is starting to change. Rather than us talking about when are rates going to stop going up, it's now we're all like, okay, well, when are they going to drop now? Like, we're all just expecting that. And that's I've always said the first thing that has to change. Sentiment has to change first. And we're starting to see that. Sentiment's changing. That'll start to bring back buyers to the market. If they start to drop rates a quarter point, I think that'll get people out. That'll be like, yep, people will be like, it's coming down now. Let's get out and buy.
I agree. I think even a quarter point will make the market go a little
crazy.
wonky.
It signals that we've hit the bottom, and that's where a lot of people.
The top. We've hit the top. Oh, bottom of the real estate.
Bottom,
got it.
The bottom, in a sense, is it's not going down anymore, and that's the signal that now it's going to, or rates. Sorry, you're right. Rates aren't going up anymore. That's the signal that rates will start coming down, and now I got to get in the market, because if they start coming down fast, everybody else will start rushing the market. So you're just going to get. I feel like that's starting right now, but we'll see. I hope you're right. I hope rates come down more than that.
Yeah, the biggest thing they just have to be careful too is our economy versus the States. We're so tied to real estate that any little change in the rates is going to affect everything massively. Where the States, 25 basis points won't make a massive movement as much as here. 25 basis points for real estate just sends everyone into a frenzy. Last year, like, we would even see it. So we'd have spells where, like, business was getting tougher, obviously, and then all of a sudden you'd hear they kept rates the same, and we'd be crazy busy. Phone calls would be going.
I remember.
And it would just be influxes, and it's like, but they didn't do it. They just kept rates the same. But that little
So maybe that we get rate drops, but the qualification gets even harder. Like, could we do that in Canada then? Drop rates, but make the qualification even more ridiculous.
I mean, you're just going to price out first-time home buyers if you make it any tougher.
I think we've already screwed first-time home buyers all around. Anyone leaving university right now, look, Aiden's about to finish Western. Think about that generation. I know we've focused on millennials, but think of the next generation coming out of school now. Starting salaries have basically gone nowhere.
Yeah.
Property prices have softened, but let's face it, I don't think there's been like a massive, we're not talking about a 30-40% correction.
And like where we were before COVID, it went, let's say, when 100% up became 20% down. So we're not like back to normal.
Yeah. So you're right. And which makes me think during the next election cycle, some of the parties, I don't even want to say the party names because I don't know if I really believe in any of them, but some of the parties are going to come out and say first-time home buyer program, and it's going to be like an 80-year, I'm exaggerating here a little bit, but 80-year amortization only for first-time home buyers to make housing affordable.
It wasn't that long ago we had 40-year. When I first got into real estate, you could do 40-year AMs. So, and I've been in mortgages 20 years now, and I've only
how old are you?
I know, mid 40s. But I've only ever really seen them take product away from mortgage brokers in the sense of 40-year AMs. No, got lowered to 35, then got lowered to 30, then got lowered to 25. So I feel like we might be entering an era where that starts to reverse now, because you have to do things. You have to change it now to make it more, affordable for first-time buyers. I
remember when Jim Flaherty, the late finance minister, made 0%. He went to 5% down and 0% down for on income proprities.
Yeah.
And the CMHC fee on those were huge. Yeah. But if you knew what you were doing, 0%. It was hard to qualify for more if you already carried some properties. But that was that was the holy shit moment. Do you know why that happened? That was when AIG was entering Canada.
Yeah.
And CMHC kind of shit their pants.
Yeah.
And they shit their pants so much that the finance minister changed the rules here so CMHC could gobble more of the market, because AIG was coming in as Canada Guarantee, and they were scared they were going to lose some market share on the insurance business. So maybe we just need a big bad American company to come mortgage insurance.
help with phone bills.
Threaten CMHC.
Yeah, it helped with phone bills.
Oh my God, somebody just told me they have a US, they're in Toronto, live in Toronto. They got a US AT&T cell phone because it's $40 a month unlimited.
Really?
Yeah.
So cheaper for them to have an American cell phone bill than Canadian.
I haven't verified this. Someone just told me that this has happened. That you can get a $40 a month, I guess it's $40 American a month, unlimited plan. So you get that plan, but you live in Toronto.
And so you just roam technically.
You're just constantly roaming. I don't know if AT&T shuts this thing down. Anyway, that's unverified information. But I hear
Call your local Rogers provider.
Go to New York State. Go to the Wegmans.
You used to be able to remember, there wasn't that long ago, you could refinance to 95% on a residential home through CMHC. So you had,
And what's the max you can refinance now?
80 through CMHC. Yeah, 80%. That was, I think, 2007, 2008 when they made that. I don't remember. They made.
Okay, so the only thing then on rate cuts that gets me again suspicious is, how we've done raises, it's been like a ladder step up. Mm-hmm. On the way down, they're never like that.
No.
On the way down, they waterfall down. So we're kind of talking like 2, or you guys are saying 2, I'm saying maybe 3 or more, but then none of us are saying like 2 percentage points.
No, you can't.
It might take a while, but I think maybe 2% in the cards over like a year and a half or 2 years.
But that's, I guess what I'm saying is like, we don't have historical precedent for that.
No, because it's never gone up this fast. So we've never, the only other time you've seen rates absolutely fall was COVID. And that was, other than that, usually it's 25 down.
You're so young, dude.
Down.
Rates went up really high, but in late 90s, 3% in 1 month.
That's pretty crazy.
Yeah. Yeah. No, it's they keep talking about quantitative easing, and quantitative easing is, slowly releasing the chokehold that you have on rates. It's a slow grind down. So
yeah, quantitative easing kind of changed the game. So maybe to Lorenzo's point, then they can kind of stair step it down over time.
I think we'll get back down 2% over the next, I don't want to be too ambitious. I would say maybe like 3 years, 2 to 3 years, maybe, because barring any sort of economic crash, and we don't know, we're really not going to know the true data of the rate increases for years to come anyways. So
you're right. Quantitative easing changed the game, and they have this other toolkit so they can drop rates a little bit, do some QE, still provide some liquidity to the market that way. So you're right. Maybe that changes the whole game.
I think it has to be a slow, because again, if all of a sudden we see a 1% or they drop 50 basis points in one shot,
I'm with you.
Market's going to be, which we'll take it, but the market's going to go insane. And then we're going to be back in the same problem, almost like a reverse crash at that point.
So with everything that's happened over the last couple of years, have you guys seen like blood in the streets, or because we have it on our side, we have not seen a rush of investors calling and saying, sell me out of some real estate. I don't care the price, get me out. There have been some people with pre-construction that maybe they wish they didn't buy and are having trouble closing on. There have been some people carrying 4, 5, 6, 7, 8 properties saying, I should probably get rid of 2 just to free up some liquidity. But even then, they're not willing to drop the price to like just unload them. So we are seeing signs of like definitely changing sentiment around real estate as opposed to 2 or 3 years ago. But I wouldn't call it blood in the streets. On your side, are you seeing people call and say, holy shit, I just need to get rid of real estate? Share everything, like it doesn't matter.
Yeah, no, I mean, I think that if you were a long-term real estate holder and you were feeling that cash pinch, because let's face it, that's most of the problems these days. It's cash
for
flow
everybody,
negative, right? That's it. It's cash flow. So if you had equity in that property, you could sell it, offload it, and still be profitable, right? So the investment was still profitable, even though you might have lost money because value dropped a little bit. You still sold it and made money. I think if you had timed it during the time of COVID, when rates were so low and prices were so inflated, that's where I think we're finding most people ran into trouble. If you want to talk like blood in the water, that's the people who were maybe they borrowed 100% to buy that property. They leveraged their HELOC. They maybe put 80%, on the property they're buying. Variable rates, the rate went up like crazy from the time they bought it to now. So in that timeline of people who bought during those times, for sure, like you're seeing new construction.
Pain.
Yeah, you see.
So what are those people? So if they bought in that 18-month window, and they're are they just, because some of those variable rate mortgages, some banks have not moved rates.
Yeah.
But then on the renewal, they're going to have a big lump sum payment and a much higher rate on renewal.
Right.
So are some people just freaking out, or is it still a year or 2 away?
I don't know that everybody's hit it. Like, I don't know that it's really hit all of those buyers. We see it for the most that, the investors that maybe have that product, that variable rate product where the payment's changing. The people where the payment's not changing. I mean, yeah, you get a few phone calls from smart investors that are trying to plan for this stuff, but I don't think if it's really affecting their payment that a lot of people are really sensing the gravity of what's going to happen. Yeah. I don't know that they even really know, a lot of them, that
until you look at an amortization year on your online mortgage statement and you're like, what the hell is that?
And do they know that it's going to go back to 30? Like, how many people put that time in to figure out, well, what's going to happen on renewal? So it's important to do stuff like that. But I think most of the pain that we're seeing is from the people whose variable rate has gone up. And, luckily, again, I used to say this, I've never seen more investors buy rentals without owning an owner occupied than the last couple of years. But a lot of investors, for the most part, I mean, we've been doing real estate together for a long time. They own owner occupied properties. So people will look at, a few different options. If you're in that bad of a scenario where you can't afford the monthly payments, I mean, selling is, especially if you're going to be profitable, it's not a bad option. I know nobody wants to sell real estate.
You need to survive.
You have to survive. Exactly. So you could sell it. We'll see people that look into putting, it's such a bad way of saying it, but people will buy themselves time, and you can buy yourself time by taking out a private mortgage. You could get, a line of credit on a property and lend money to yourself.
It just always scares me.
It's very scary, but this is the things people are doing in a market like this, right? So it's like when we're getting blood on the streets, it's a lot of people having to take private mortgages to offset those high costs. It's appraisals coming in low, like we're seeing on new constructions, things like that. If you bought a new construction, the appraisal might be coming in lower than the purchase price. Yeah,
the biggest one, honestly, is we hadn't like Dan said, we've had investors, obviously, but those are very, I guess, we'll call them like fixable solutions, because you can just sell your property and it's not necessarily the end of the world. Sucks, but it's not the end of the world. We've seen a few, I would say, on the new construction side where people that probably should, or were given bad advice from someone, or probably shouldn't, because
you just put down a bit of a deposit, you lock it up,
thought they could figure it out in a year or two from now. All of a sudden the builder's rushing to close and they're sitting there saying, well, I didn't get my credit fixed, I don't have any income, or I lost my job, and my house is probably worth $100,000 less. Like, what happened? So I've seen a couple people just flat out just give the home back to the builder. Just literally, like, there's nothing much you can do. We've also started to see builders people got to really push for this, but they don't want to do this. But builders start offering vendor takebacks now just to get people to close by them sometime. Hopefully they can qualify for a refinance and pay the builder out. So that's where I've seen most of the hurt, to be honest with you. Because those ones, if you just put $20,000 down, $50,000 down, slowly made deposits, didn't think about it, now you're in a tough time. Especially if you were told you'll qualify at the time, because now you're qualifying at rates that are like 3 times higher almost in some cases. So you might have qualified 3 years ago to buy, but today you don't qualify. Wild times, man. So then I guess if we all think rates are coming down, then I think they're not. Because I'm like, oh man, we've all just accepted they're coming down, but the opposite would be they go higher. They can only go higher if inflation gets hot really quick. And inflation, the only way inflation goes crazy up now would be some big geopolitical thing that we don't see, where oil goes crazy. So it's definitely possible. The world's wild. So it's possible. Sorry, Lorenzo. The other thing in Canada, a lot of people don't realize is that, like you guys mentioned earlier, a lot of people's mortgage payments haven't even changed yet, but that's all going to start coming up in 2025. Okay, so this is what I was going to ask then. In 2025, that's an election year. Yeah. So that's why. So the Liberal government, a whole bunch of them come due in 2025. I think 2025, 2026 is when a lot of these mortgages come due. So are the Liberal government going to just stand there and let people scream at them as they try to renew these mortgages? I don't think they can be, or else to me, it's an automatic loss. And then the other thing is that inflation will have to come down, because all those people that haven't necessarily felt the pinch yet, well, if their mortgage payments all of a sudden going to increase on them by a couple $1,000 a month, $1,000 a month, their discretionary spending is going to start decreasing no matter what. So it's going to hit a point eventually where I think inflation just has no choice but to come down, just because, again, all the rest of the people's renewals come up. Now they're paying higher. There's just less money in the market to be going toward a mortgage that can't go somewhere else. Yeah, so maybe we get a couple rate cuts with QE. They inject a bit more liquidity, right? Because they don't need to just do rate cuts. Correct. Do a couple rate cuts, do some QE, devalue the currency. So maybe the price of everything keeps going up on us, but they have done that, kind of in a stealth mode. And that's kind of the combo we get. A little bit of rate cuts. So maybe it's just 1 or 2 rate cuts. Which isn't a bad thing. And the long term, right? Yeah. To Lorenzo's point, if you do it too fast, if you drop rates 1% today, I just feel like people, you drop the cost that much, spending is going to go crazy and inflation will go up. And then you're just going to be forced to drop rates again in the next couple of years, increase rates again in the next couple of years. We're so tied to the U.S. You know what the difference between Canada and the U.S. is? A lot that doesn't seem to get discussed in this country at all is whenever I talk to friends in the U.S., our mortgage rates here are always lower. Oh yeah. So whenever you see charts of how much debt the average Canadian carries, it's through the roof. Right? whenever you see those G7, but part of the reason it's through the roof is that if our mortgage rates are lower, you're going to have more debt. We're going to have more debt at the same monthly carrying costs. And all anyone cares about is the monthly carrying cost. So when I see those G7 charts, I'm always like, is nobody correcting for interest rates here? Because if in Canada, our interest rates are a full point lower than the US, and when they were lower and the US rate was 3, we were 2%. Yeah. That's a huge difference in carrying costs. And even now, when I talk to US friends, they're telling me our mortgage rates are less here. I'm not saying that's always the case for everyone, but in the vast majority of cases, there's that. And then on the appreciation side in Canada, it's pretty wild. We get a huge amount of immigration per capita. I think we're still number 1 in the G7. I should check that. I assume we are.
But the difference between us and the US is their appreciation gets a bit muted in real estate because they have so many big cities for people to go to. Whereas in Canada, all of our immigration goes to like Montreal, Vancouver, more and more of it to Alberta too. But then the vast majority comes to Ontario and the Golden Horseshoe, and it just drives the appreciation. That's very different than the US, where if you go to like Texas, for example, you got 3 or 4 cities right in Texas that are pretty big you can move to just in that one state. And then Florida the same. New York the same. So you can, it's a totally different environment.
Very different.
And it drives the, by the way, I'm not saying we're better because of that. I just mean it's a different dynamic and it kind of drives things. So when you see numbers of real estate prices, like you kind of have to correct for some of these variables. Otherwise it just doesn't make any sense.
The other thing I watched a really good video on is that people in Canada, let's say you have money to invest, almost all Canadians will go toward real estate first, whereas Americans, it's easy for them to start a business, a lot less red tape in the States. They're more open to investing in other things, different, like obviously business ventures out there where they're a lot more diversified than we are. Canada's just, as soon as you get a little bit extra money, try to buy a rental proproperty, which is good, obviously great for real estate. Real estate's a great investment, but it all keeps focusing onto one thing for us. So we become so tied to it now.
Yeah, because of those dynamics, they've kind of proven that real estate is like, oh my gosh, you're going to make quote unquote, you're going to make money in real estate. But in the US, you're right, with such a big population there, it is easier to start a business because you have so many customers everywhere. Almost every idea. You look at just the volume, like shit, I can start a business because look, there's 350 million people that can buy from me.
And so more people with money to invest will maybe start a side business instead of buying real estate. Everyone keep buying, you're just going to keep forcing the prices to go crazy.
Yeah.
Easier to start a business down there than it would be to buy a property here if you were a Canadian.
I never thought of it that way.
Well, here you got to have like provable income. If you want to get money from a bank, you have to have that provable income. You have to have everything. If you're trying to start a business in the US, I mean, I don't know the criteria, but I'm just saying, just imagine where you have to start to borrow mortgage dollars in Canada versus a business in the US, where you're probably not showing much declared income at that point because it's a new business.
Regional banks down there much easier to work with.
Who's qualifying with you guys right now on mortgages? Obviously, some people are though.
Yeah, I mean, I think nowadays you just see more and more co-signers for sure. Yeah,
okay.
If the bank of mom and dad has become, probably the best
mandatory.
Bank. Yeah, because co-signing. I mean, you mentioned it today. If you want to buy a property in Canada, let's say an insured mortgage, so less than 20% down, you're going to qualify for about 4.5 to maybe 4 times your income. For a property. So if you're making $100,000, you'll qualify for maybe a $450,000 to $500,000 property. And how many people are coming out of college making $100,000? Number one, and where are you going to find, especially in Southern Ontario, a property at $500,000? Maybe a condo, but it'd be pretty hard to find, a detached or even a townhouse at that price. So, and you need $100,000 of income. So sure, you could get 2 people starting at $50,000 each, but coming out of university, unless you're marrying the significant other, that's even questionable. So you need mom and dad to help co-sign and offset that debt service. That's the biggest thing. When you're trying to borrow money from a bank, they're really just looking at 3 criteria. Do you have the minimum down payment, which on an owner occupied is 5%? How's your credit? You have to have good credit. And what is your debt service? And debt service is all about income to debt. So if you graduate with student loans and you have monthly payments, that's going to hurt your ability to qualify. If you have a car to get you to and from work and you have a monthly payment on that car, that's going to impact your ability to qualify. I said that number of 4.5 times your income, that's assuming you have no debt. You start adding on student loans, car payments, you might get down to like 3.5%, or 3.5 times your income. So it's not easy. You got to have 20% down, or co-signers to really, get in the market.
What a fucking mess.
People just don't even want to buy 5% now because the payment's just so high. So let's say you can get past the qualifying, you find the place you can actually buy. Now your monthly payment's like 60% of your actual take-home income. You're like, how does this even make sense for most people?
So most of the investor activity we're seeing right now will be student rental properties. Those, they just because the revenue on those is strong, or people looking at like but you have to have the funds to do this. Single family home that they're turning into a duplex or already operating as a duplex, and then hopefully even a triplex by some way, laneway in the back, garden suite in the somewhere on the property. in the future. Yep. So even if they're buying it and it's like, holy shit, the numbers aren't fantastic now, I'm going to add on a garden suite at some point and I'm going to have the property that way. But to do that, you need to have the money to pull it off. If you're going to convert something into a legal second suite, not everybody has the $150,000 to build out the basement properly.
So we look at mortgage payments every day, right? That's something we do every day. It's crazy to remember.
You have time between checking on KC and any off-season moves?
I try to make a little time for mortgages.
Do you? Okay.
My fantasy football takes a large part of my time. But yeah. What was I saying? You got me.
You look at mortgages.
Mortgage payments. That was what I was going to say. So right now in Southern Ontario, if you're going to buy it, let's say a $700,000 house, if you're borrowing the money from a HELOC, you're going to be cash flow negative big time, $400 or $500 probably, something like that. But if interest rates drop 1% and you are not borrowing that down payment, say you have cash or you cash out an investment, whatever it is that you do, you're going to be cash flow positive in Southern Ontario. So because the rents are so high. So, now is an interesting time. I don't ever want to be like the guy that's like, well, now's the time to buy. But if you were an investor looking to buy, you would want to look at properties when they're sort of priced here and rates are here, because over time, over the next few years, the value of that home, I think you'd agree, is probably going to go up, but the cost of that mortgage in all likelihood is going to come down. So if you can get in, and the rent's going to go up, so your margins are actually going to improve if you're an investor.
Yeah, and you're right, and you're hitting on all the big themes that we always talk about, that like leveraged income real estate is still one of the best ways to outrun the debasement of the money supply in this country. We just ran the numbers. The compound annual growth rate of M2 from the year 2000 to 2023 is 6.9% roughly. Real estate is the same. Compound annual growth rate of Toronto area real estate is 6.9. Yeah, it's not outpacing the devaluation of the currency. But if you put 20% down and you get a 7% return on that 20%, you're growing your 20% or your net worth or your down payment. Yeah. You're growing that 35%. So that 35% is outpacing the debasement or the devaluation of the currency. So you're still getting ahead. Yeah. So you kind of have to figure out how to maneuver around this stuff, because if you don't, you're left with an income that doesn't get you ahead. If you have fully paid off property, not leveraged, it's not really outpacing the debasement of the currency. So that's not really getting you anywhere. The S&P 500 as a standard index grows about the same. It's not really getting you ahead in purchasing power terms. So it's kind of unfortunate that we're all forced into this situation where you kind of have to figure out this mess, to your point, Dan. So it's not really, to me, when I hear you say that you're saying, I hate to be the guy that says you should do this, but how else is anyone getting ahead?
Yeah.
I don't really meet people. I mean, we can talk about Bitcoin in a second, but there's really very few financial instruments that allow you that leverage. Yeah. And to me, real estate, the only great part about real estate is the leverage.
Yeah.
All the other stuff kind of sort of sucks.
Kind of a pain.
Yeah. Dealing with banks, dealing with people, like all people, contractors, property managers, and everybody. And we've had great contractors, great property managers, great tenants, but just dealing with it is all a bit of a pain. So when you kind of break it all down, it's the leverage that
makes sense. Why would you not just buy the S&P and wait?
Yeah,
exactly.
Or just buy anything and just kind of let the debasement pretend it's pushing up. It's basically a big money illusion, all of this stuff. Yeah. So I think it's valid when you say you kind of have to evaluate these things. I just don't understand how the average Canadian or person in the world can outpace what the bankers are doing. It's just a complete nightmare.
Well, sorry, I didn't mean to interrupt you.
No, sorry, I'm pissed.
No, I was going to say, look at, shout out to Andrew Politis. Andrew said that years ago. A lot of investors looked at, well, my property is not cash flowing anymore, so I don't know if it's a good investment anymore. And Andrew's like, well, what are you putting into the property? You as the investor, if you have a $800,000 property and it's going up at 5% per year, it's $40,000 a year. If I told you, give me $300 a month, for the next year, that's $3,600, and I'm going to get you a return of $40,000. Now I know there's capital gains and losses and taxes and all that, but that's looking at it differently. Real estate investing these days, I'm very cash flow. Cash flow is super important. So don't take it the wrong way. I'm not saying go and invest in cash flow negative properties, but the perception that a property has to be cash flow negative isn't always true to your investors. We have clients that are doctors, that are lawyers, that maybe or bankers that have high income coming in, and a negative cash flowing property to them, a few $100s a month, they see the benefit of the property going up in value. They maybe can write off some of that loss against their income. So it's the evolution of the investor. The investor, rent to own used to be like the big thing where it was rent to own. Then it grows into something else. It grows into long-term rent, then BRRRR strategy, then ML, all these other sort of programs branch off from it. But
as crazy as it sounds, I think rent to own is a good environment to be doing rent to own now
come
because
full
people
circle.
can't qualify.
Yeah, a lot more. Funny enough, especially when the rates first started going up, I saw more rent to owns in like that 2-3 month span, and I was like, oh, this is weird.
No way, really? Yeah,
just a couple here and there.
Rent to own always gets shit on, but we're like, hey, there's the right environments for rent to own. And right now, I feel like when people can't qualify, it kind of gets you in. The investor gets a bit more cash flow. You get money up front. It kind of works on both sides. It's the right time for this.
Especially too, not knowing where housing prices were potentially going to go. Now you've locked in 5%, whatever your increase is. It's like it does. It's a bit of
a gamble on both sides, right? Like who's going to win on that situation? You sign the option agreement. You kind of have you place your. It's like both parties placing their bets. And then I was going to say something, Dan, on your point about, looking at real estate the way you just described it is Mike just got an email from 2 medical professionals who basically invested in the stock market their whole lives. They're very high earners. And they basically said, listen, we're not getting ahead. We need to now go into real estate. And it's because they didn't have the leverage with the S&P 500 or whatever stock indexes and stocks they're investing in. They're not outpacing the debasement. So they're realizing their purchasing power is really not getting ahead. And they almost like begrudgingly are saying, okay, can you help us get into some real estate? Because they're realizing, I think maybe unconsciously, they're not really getting why, but they're realizing real estate offers them that ability. And if you boil it all down, it's because of the leverage.
Yeah. Yeah.
And so some people who've invested for 10, 15, 20 years are now saying, oh my gosh, which is a shame. This should not be the case. I hate that we're in a world that lives like this. But now you have these people who are working hard, serving their community, making a great income, thought they were doing the right thing, looking at their financial statements saying, we can't retire. We need to pull in some of this leverage.
I saw, just side note, I saw, there's a lot of social media experts these days that like to say that they're the pros in real estate. And I saw, won't mention any names, but I saw some.
Oh, come on, just mention. No, I'm joking.
But I saw.
No.
And in fairness, maybe they have an explanation for it. But God forbid, I couldn't understand. They were promoting. The headline was why you should never buy at 20% down. Why you should put 10% down because you're going to get a lower interest rate, and you should take that other 10% and reinvest it in things like the market. And I wondered to myself, what do you say to the people who did that right before the rates went up, and those people unfortunately maybe lost everything in the market, and rates have gone up. Their cost has gone up because they did 10% down. Maybe they took a variable rate, or their payment's higher than it should have been because they're on a 25-year amortization and the market's dropped. So I don't remember the point I was trying to make about that, but
no, just that it's a wild world.
It's a wild world. That's it.
So speaking of the wild world, I mean, recently there was some stuff in the news about a whole bunch of mortgages blowing up. I'm hearing through the grapevine of like a couple other situations that may or may not make the news that are kind of blowing up. What are you guys seeing out there that's kind of, I don't know, catching your attention, scaring you, or I don't know, maybe not even scaring, but like surprising you? What are you seeing out there?
Well, one of the things I think that surprised us over the last few years was this craze of people buying with other people's money, leveraging to the max to get ahead in real estate, real estate professionals out there.
Willing to pay super high interest rates to do it as well.
Which for a short period of time, like we talked about, maybe made sense over a year period. If the property is going up 20, 25% and you borrow the money at 15%, maybe it made sense for 1 year. But one of the things that you're seeing now is that is being exposed is some of these investments are starting to go bad.
So the one that hit the news was where people were borrowing privately using promissory notes. I don't even know the exact structure of it, but I think they were borrowing on a promissory note. So when you lent the money, there was no collateral on the other side to secure your lending against. You were just saying, hey, here's some money. And the other person was like, I promise to pay you back, basically.
Yeah.
It's a promissory note. And then that money was being used to invest in real estate. The market changes. shit hits the fan, and then I guess the person who lent the money doesn't have much recourse.
There's so much to break down there because well, in a good way, because yes. So what you can read in the news, people can Google,
but that's the big one that kind of,
this was the big, there was a couple, there was one in BC as well that it was happening to as well. But the more recent one that CBC did an article on, so they were, let me start from the beginning. So as a private lender, you don't really ever leverage yourself past 80% on the value of a home. Okay, that's a standard sort of number. I don't go past 80% on the value of a home. So anything over 80% in our eyes would be insane.
80%.
And this market, even 80% is crazy. Now, I've dealt with private lenders that lend to 85. I've dealt with private lenders that'll lend to 90. If they want to lend other people's money, like, you go right ahead. But we wouldn't lend past 80%. So it sort of starts there. Now, when you're a private lender, you run a big investment club. When you're a private lender and you're looking for ways to invest in real estate, one of the things, people, Rockstar members might say is, well, where can I lend privately? Where can I lend privately? And you might say, on a good day, you might say, well, go through Dan, and, might say, go through Lorenzo, something like that. Call those guys, see if they can get your money out. Now, that investor is an everyday investor, right? They're not necessarily a seasoned private lender that understands how to read an appraisal, understands, comparables, understands, all the things that a private lender should know. So they would come to Lorenzo and I and basically put all, their trust in Lorenzo and I, that if we say this is a good investment, we put our stamp of approval on it, you're going to give us your money. We are blessed to be in a position where it would be very easy to raise a bunch of money from investors. We get, we take that very seriously. We are very anti-risk. So this mortgage broker, from what I understand, there was many people involved. There was some realtors involved, and there was some construction companies involved that they're all sort of intertwined. Like I said, you can look it up. But the mortgage broker was arranging 3 different types of loans.
Okay.
They were arranging first mortgages. This is from what I can surmise from reading. They were arranging first mortgages to the 80%, which these are in small markets. I think Sault Ste. Marie.
Yeah. And the first mortgage lender was a bank or
private?
This was private.
This is all private.
All private. Okay.
So the mortgage broker would say, let's imagine, I say, Lorenzo, you're going to be the first mortgage lender. You're going to get a return of X amount. Here's you're going to get a monthly return of this, and this is your investment. You're at 80%. You're the less risky.
They're going 90 to 100 sometimes too.
So then I come to maybe somebody like you and I say, okay, well, you're going to lend him now, or you're going to lend me the 20% as the down payment. So he's lending me the 80%, and you're going to lend me the 20%. But you're going to be in second position now. So you're going to be riskier. You're going to make more money. But if he's loaned to me at 80% and you're loaned to me at 20%, what's your loan to value? 100%, which means if anything happens in the market and the property drops in value, if the client goes arrears on their payments and there's fees that are added on. And
they were able to get people loaning that 20% up to 100%.
Well, again,
you're just surmising.
Oh, no, they were able to.
They
were. That is what happened.
Oh, okay. So then on top of that, under the promise of, we talked about earlier, under the burst strategy, they were telling these investors, we're going to buy these homes for $300,000, whatever the price was. We're going to leverage them to 100%. We're going to have the investors, we're going to leverage them to 100%. And then we're going to increase the value. We're going to do all these rentals. We're going to pay these companies that we also
Okay,
own.
so that's how they were able to talk about the story of a higher value.
Exactly.
And getting more loans against the property?
So that's where the promissory notes came in. Now, it's very hard to convince somebody to register a loan at 125% of the value of a home. It doesn't even compute. The math ain't mathin'. So you do that through promissory notes. That's what the broker was doing. It seems that they were going to other investors, maybe even the same pool, and said, listen, if you want to make an even better return than that second mortgage you've got, Tom, why don't you give me a promissory note? It's not as secured, but look at these borrowers. They've done this before. They're going to make this house $400,000. They have a track record. Why don't you and you're going to make more money on that because it's riskier. You're going to make more money. Now, the problem with the promissory note is there's zero security on it. I tell people all the time, like, we won't touch them. If a client calls me looking to lend out money on a promissory note, I tell them I wouldn't lend out on a promissory note. Like, it's insanely risky. But again, if you trust the person investing your money,
And I have some sympathy for the lender because it's so hard to get ahead in today's world that if you hear a promise of an interest rate that looks attractive, and everyone's working hard, no one can save. Yeah. And if you kind of have, and you don't see or, smell anything wrong here.
And it's tough today too. So a lot of times all of a sudden you see on social media, this person going out and doing all this through promissory notes, or you start to see people making it look like they've now done what you could be making money off of essentially. You think it's okay because obviously it's a fake.
Yeah, so then you're missing out. Yeah. You're not participating.
Exactly.
There was investor packages going out with the borrower's name, identity of who they were, what they did in the community, why this mortgage broker felt that they were trusted borrowers. And if you're giving that sort of thing to your average, you said it, we're not talking savvy private mortgage lenders here. You're talking your average Joe, your rock star member who's looking for a way to get ahead in life, looking for ways to invest money, and caught by, unfortunately, sometimes the allure of quick money, which happens all the time. And even we would get calls all the time from people in the last couple of years going, how are people doing this? How are they buying this? And
oh my God, one of my favorite stories was like in 2012 or something. We had an investor we were working with run through the doors of our old office and say, Tom, Nick, I need to talk to you guys right now. I need $50,000 from you right now. We're going to buy these properties. They're selling for pennies on the dollar. It was U.S. real estate kind of at the end of the great financial crisis, still depressed. Maybe it was 2011, 2010, maybe it was 2010. I can't remember the exact year, because they were pennies on the dollar. And I guess someone on the weekend had hyped them up that this was the opportunity of a lifetime. Yeah. And we were just like, oh my gosh, like take a breath. Yeah. Let's slow down. And we looked at we asked for some pictures of these properties. These properties were a disaster. And as soon as the person saw the pictures of the properties, they bailed on it too. But in that moment, they were willing to buy these properties for quote unquote pennies on the dollar. Yeah. So I think it's just the emotions, like you said, Lorenzo, like you see stuff on social media, you think people are getting ahead, you're missing out, you're trying to save for your own family, you're trying to do the right thing.
Yeah. It's
so there's that situation. Are you seeing any other types of situations out there? I've heard of other things where some developers unfortunately have raised money, privately, and then their development projects, it's capital intensive to develop, right? By the time you buy a lot, rezone it, try to build it. If interest rates go higher on you, it can get difficult. So some of those people are struggling. I think there's going to be losses in that world.
Let me just go back for 1 second to wrap that up. Yeah. I just want to explain how that house of cards falls. How, listen, in a market where those properties are going up, in a hot market, maybe those values are going up after the renos from $250,000 to $400,000. But as soon as the market changes, or the houses, I don't think they were doing the renos that they were promising they were doing.
It didn't look like it.
Yeah, it didn't look like it anyways. But as soon as those values aren't coming in anymore, the game's over. And that's where you don't have necessarily the funds to pay back the investors. And that's when, if you don't have the funds to pay back the investors, they start asking for their money faster, quicker, word starts to get out.
And when you say pay back the investors, you mean the interest payments that were being paid?
Well, I don't know how long the promissory notes were. Like, I don't know.
Probably a year?
I'd be surprised if it was even that long. I would guess a promissory note's probably like 3 to 6 months, something like that.
Okay, so
some of them are a year. Like I've seen stuff be a year, but it just all depends on how they were set up.
Okay.
So if all of a sudden you did, maybe let's say you did a promissory note and said 6 months of like a balloon payment essentially, now your 6 months has come up and you're expecting your money back plus the interest, and all of a sudden that day doesn't come. And then words, just like Dan said, someone start talking to someone else about it. That starts to build.
It's like a bank run in a weird way. It's like a bank run. Everybody starts calling, wanting their money back. And that's when you have to go into, and I don't mean just the broker. I'm talking the whole business that was operating this.
Yeah, it just starts to crumble.
You have to go into that.
I was talking to a real estate lawyer who's saying they're dealing with a couple other situations like the one you've described that are actively blowing up that haven't hit the media. They didn't really give me any details. They didn't really want to. I don't blame them. So are you guys hearing rumblings of other things on the streets now?
We've heard of a couple that were potentially like stuff, people starting to not get back to emails, things like that. So we've definitely heard of a couple, because it was something that, again, through COVID, real estate going crazy, everybody was a guru. So it started happening a lot. And I think honestly, the biggest takeaway for everyone is that real estate, especially, it's not something where you're supposed to get rich in a year or 6 months or 18 months. It's a slow grind, right? And especially when you're lending someone like your money to do a project, you have to be very trusting in the person lending your money or you're lending to. too. But B, also doing your own due diligence, understanding what loan to value is, understanding where you're at on this property. If the guy defaults, am I in second position? What happens to the guy that's in first position? So being able to really like educate yourself, like that's for a lot of people. Like, we'll be running probably classes on that this year now, especially with all this going on, and how to kind of get that set up, because that's super important for someone looking to diversify from keeping buying real estate to maybe they want to private lend a little bit too. It's always important to understand where you're at in your investment essentially, and what your recourse is if things go bad as well.
It's funny how human nature works. I remember when I was younger, maybe 2003 or 4, somebody that I was working next to said they had discovered some mining company that was going to go from like, I don't know.
Oh, I got one of those tips.
15 cents to like, 45 cents.
They discovered lithium was the one.
Yeah. Okay. Mine. I guess that was like the early crypto.
Yeah.
Do you know what I mean? Like now it was like all the crypto stuff over the last few years. That was like when the crypto was still in the ground.
Yeah.
And it was like, you buy this thing at 15 cents over the counter or whatever. I'm like, I didn't even know how to buy it. I had to call somebody. Yep. And I think I probably put in like $2,500, which at the time was like $2,500 I could not afford to lose. Yeah. And I immediately, like, I would do that on Tuesday. By Thursday, it was gone. Yeah.
Like, one of the ones you don't tell Carol about, eh? $2,500. Yeah.
It's like, whatever happened to that money? Whatever happened to that money for the dining room table that we were sitting at? Oh, we don't need a dining room table.
I'm going to make it back triple, babe. Don't worry. Lithium mines. I
remember in our first house when Aiden was born, we had a Fisher Price table. This is back when I think like everyone used to save for things. We had a Fisher Price table in the kitchen because we couldn't afford a kitchen table for like 3 years. It was one of those ones that go outside like with 3 colors on them. Yeah, it sat in the Mattamy home that we had just bought. We had no extra money. We had like the builder's chandelier that was worth 3 cents that came from the ceiling, and under it was Aiden sitting on a Fisher Price table, and that's where he like ate breakfast every morning. And we were up on the counter of the kitchen, and we had no kitchen table because we had to save, probably because I invested in some mining company.
Amazing.
But everyone goes through that, and it's an unfortunate path as an investor. I'll never forget our accountant who passed away, our original accountant passed away, and he was a great business mentor to us. And he said him and his accountant buddies would always get together, and they went early in their careers. They were amazed by the tax returns they would do from either real estate investors or businesses that were just growing like a rocket. Then they would come to realize after a few years, usually those weren't sustainable businesses, and they would come crashing down.
Yeah.
And the guys and girls who just kind of invested or built their business really slow and just grew. He said it was kind of like going up a ladder. Like they would plateau for a few years, and then all of a sudden their income and their wealth kind of just took a big step. And then it would plateau again for a few years, then would take another big step. And they looked back at the end of their career, and they concluded it was the turtle who won the race.
Yeah.
And he gave us that kind of advice because I think when Nick and I were kind of starting, we would hear stories like people making big money, and you're like, do I even know how real estate works? Am I doing this right? I'm not doing all these wonderful trips that I'm hearing about. And he just kind of calmed us down. He's like, guys, it's the turtle that wins the race. I've seen a lot of this stuff. Ignore the noise, put your head down, buy good assets, and stay the course. And it was like the best advice we ever got.
It is great advice.
It's the truth. Lorenzo's right. You don't get into real estate to get rich quick. I don't know any get rich quick. You
get into real estate early to suffer, deal with problems,
but then to
scream at banks,
scream at lawyers, but to look back on your portfolio years later, that's the goal.
Yeah. Nick and I look at some of the early stuff now. We're like, holy shit! Like, there are some properties in Hamilton that I swear I thought we got ripped off on, and now we're like, why didn't we buy the street again? Yeah. And we've refinanced a couple of those twice. And even now the mortgage on them is tiny, and like almost a non-existent, and they're great properties, and but they're kind of just boring. Like all we did was just buy a rental property, run the numbers, and hold it. Yeah, we did refinance a couple of times, like everybody does, to try to build your portfolio, but that was it.
And some years it goes up a little bit, and some years it goes up a lot. And in odd years it maybe drops a little bit in value, but overall the investment's there.
Yeah. Anything else going on in the mortgage world that you guys want to talk about? I think to me, BMO was the big one. BMO coming in, MLI Select getting a lot of attention. Yep. BMO coming into the mortgage channel. This next year, I guess we'll just see where interest rates are.
Yeah, bank product is still very similar to what it used to be. I mean, it's harder to qualify.
What do you mean by that, bank product?
So just qualifying for a mortgage, like it's all the same rules. I mean, it might be tougher now just because it's, rates are higher. It's harder to qualify. You're qualifying for more money these days because prices are higher, but it's the same documents. It's the same rules that it's always been. So it's nice to see banks like BMO come into the channel. I know with Lorenzo and I, with Better Mortgage, we have the ability to work with banks that don't even work in the broker channel. So we have access to lots of different lenders, which to an investor is massive because it's like a puzzle, right? When you're trying to qualify to borrow money from a bank, they're not all the same. They don't all have the same rules. So the more lenders that you have access to, the better shot you have at getting the money you need because these.
So not all mortgage brokers are then the same either, because you're saying you're on the BMO list, you have access to other programs that people don't have access to just because of the length of time in the industry.
Yeah, and we've curated, good relationships through outside. You're absolutely right. Listen, there's a lot of great mortgage brokers out there, 100%. We like to think we're one of them for sure. But that's one of our big advantages is that we don't just work with banks inside the broker channel. We've had to work with banks outside the broker channel because, again, lenders need access to different products that may not be offered through the broker channel.
So when an investor comes to you, the process is what? You're evaluating to see what they can begin with, I guess?
Yeah, we have a
standard practice.
We like to start too. It's like, what do they want to do first off? Do you someone that wants to get to 20 properties? You someone that wants to just get 5 and you're good, or 3? So it kind of starts off that way. It's basically them telling us, hey, what their goal is. And then from that point, we can kind of take all their information back and kind of put a plan to achieve their goal. And then obviously if someone says, hey, I want to come and buy 3 properties, 4 properties, we'll set that up. And then kind of on the side, something Dan and I always do is set up a way just to show them if you wanted to go past that and get to the 15, the 20 number, the 5 number, the 8, whatever.
And that matters because some banks are different, right?
Correct. Yeah.
BMO will have their rules and how they lend, which is different than TD and Bank of Nova Scotia. So you kind of, if somebody has a larger goal, it may change which bank you go to first.
Exactly. It's not as interest rate sensitive at top. You can't be as interest rate sensitive at that point, because if you want to try to nickel and dime your way just to go with a certain lender that is better actually later on versus now, and all of a sudden now you're buying property 6, and to be honest, that $20 a month you were saving before didn't really do anything for you, and that inhibits you from buying that next property. It's always about the proper going order, we call it the order of operations basically. And
are people open to that? Do they understand?
Yeah, they do actually for the most part. Once you show it to them, like we said, we do a lot of Zoom meetings, we'll share our screen, once we show them basically how the path for them to acquire properties, most people honestly are very open to it. It's actually something, and some people are, to be fair, like, no, I only really want 2 properties and just find me the best rate. Yeah. We do that all the time as well. But someone who really wants to scale their portfolio, they're very open to it actually. Which
is also fine. Which, if somebody, when someone wants 2 properties, I mean, if you get 2 properties, it could change your life. Yeah. Like you don't need to get to 20 properties.
No, exactly. The majority of investors buy under 5.
Yeah.
That's more than enough.
2 or 3 properties. Yeah.
Especially in Ontario right now.
Can you afford to even buy anymore? But I mean, 2 or 3 properties with the leverage, especially in those beginning years, by the time you own the property, you lose the leverage near the end after you've put a lot of property, paid down the mortgage, and then the property's just not returning as much as it once did. So, but those early years when you're compounding and you don't have that much in the property, 2 or 3 properties really can change your financial life. Awesome. So I think and I think over the years, we're just talking about stuff. I've always met people who have just judged people on the amount of properties they have. And I'm like, why are you doing that? Like this person next to you might say they have quote unquote only 2 properties. And maybe you're judging them because you think they should have 20, but why are you judging them? Those properties are fully paid off.
Yeah, exactly. If you have 20 that are mortgaged to 90%, it's like, what's the difference?
There's
you just got a bigger headache.
I sometimes, I'm not sure about you, but I not like an interview, but clients will ask me, and how many properties do you have? And there's a weird insecurity on my end because I don't own as many as people would think, but I do private lending. There's lots of ways to invest in real estate, but you're right. It's like people measure how many rentals you have. I mean, I've got 1 rental and I got 1 owner occupied right now. I'm looking at another rental, but I don't need to have 10.
I think it's 15. Because when people are getting started, you read a lot of investing books that are like, don't take advice from anyone who's not doing what you want to be doing. So, and there is a lot of truth to that as well. So you can see where someone's coming from. I mean, the whole game, life is just nuance. Yeah. If someone wants to reach you guys, what's the best way? On Instagram, email, websites?
Instagram, you can get us at Better Mortgage Select, our website, www.bettermortgageselect.ca. And then you can email us at info@bettermortgageselect.ca.
Yeah, cool.
And Lorenzo will give you his cell phone number on air too.
Yeah.
Yeah, you hand out a cell phone. Yeah, cool, guys, man. Thank you for appreciating this.
Always
and Dan,
a
like,
pleasure.
I guess KC will never win again.
Three-peat. We're going for the three.
No, look how quick you said that.
We're going for it.
Dude, the Bill,
Kansas City Chiefs will never
So the
be
Bill,
the
this
underdog.
isn't the Bills' year next year.
No, it's not
Maybe
the
2
Bills
years.
next
The,
year.
the league is rigged so they can win 3 in a row.
Oh, stop.
I'm with Lorenzo, dude. Yeah,
Stop it.
yeah. If they win 3 in a row, let's face it, it's all fixed.
is rigged.
Stop it. Taylor Swift.
Bills,
Yes.
maybe.
How can you argue with the audience? You know, 300. I had a friend at my house. Like this, people say, "Oh, doesn't it bother you, Taylor Swift?" I love it. I don't know a lot of Taylor Swift music.
Doesn't matter to me at all.
I love it. It doesn't
I just
matter to
want
me
the
either.
Bills to win.
But you know what's cool is I had a friend come over and watch the Super Bowl, and his daughter came. 18-year-old daughter came over because she wanted to watch the Super Bowl because she thought she'd see Taylor Swift. I mean,
And that made you happy, eh?
Yeah, that's a
that
great
really
thing.
made you happy.
Well, and the Chiefs win made me happy, but
So if she came over to watch and the Chiefs lost, you'd still be
Everybody
happy.
out of the
You're just
house.
happy because
Yeah, I was
they
just
won.
happy that
You're-
the Chiefs won. Yeah.
The Bills. So
Everybody-
when are the Bills going to win? What year?
it's going to
Not
be a
next
while,
year?
man. I like to think, I tell Nadeem all the time, but just to make him feel better, I say, Alan's going to get one, Nadeem, because I can just hear the pain.
No,
in
he's
his
going to get
voice.
one. He's too good not to get one. Allen's going to
He'll get one.
I'm not sure next year is the year.
He'll get one. He is too good.
Aaron Rodgers is back next year, so the Jets are going to win.
I don't think so.
What about the Leafs? When are the Leafs taking it home? This could be the year.
This is the year. I think this is the year, Tom.
Solid defense, solid goals.
I think every time we do this podcast, we're like, I think this is the year. I'm pretty sure
We're
this
2
is the
parts
year.
away. We're just 2 players away from having a solid team.
We watched that epic comeback together. Do you remember? We watched that overtime comeback at the
Oh,
cottage.
yeah.
Oh my God, I forgot about that. Oh,
Yeah,
and
the
they still let us down later. But
They lost. They
if
lost
the
in Game
Leafs
7.
win, I think we're just going to shut Rockstar down for a week.
Yeah, it's a good
like
idea.
forget the day off. It'll just be a week off.
Yeah.
And like one day we'll just, maybe we'll just have like a parking lot party.
Yeah.
We'll just get some food trucks.
That's great.
And just tell everyone to meet outside and play some music and just do nothing. Just like
You kinda have to.
dance and eat and drink.
They
Yeah,
need
we
a
have
goalie, Tom. They need a goalie and they need some defense.
my father has been, my father is a longtime Leafs fan. I think he was a Habs fan for a little while, which I hate to admit, but it was that era of like Larry Robinson. I think his era I think there might have been a Croatian player in there or somebody, I forget. And, he then became a Leafs fan, but the other day he's just cursing. He's like, they're not going to, I'm tired of cheering for the Leafs. I think, what did you say, 57 years since they won or whatever.
a lot of pain.
Whatever. I haven't done the math on that, but that does sound roughly right. And then he said, I'm done. I'm like, Dad, this is the year. He's like, don't talk to me. And then he tells me about this story when he came to Canada. Someone said, hey, the Leafs are going to apparently win the Stanley Cup. I don't know if it was the final game or it was one of the games at the Gardens. Do you want to come with me? And my dad was just into Canada. It was he came in 1965. So I guess this would be 67, their last cup. And he's like, no, I heard they win all the time. So this is what he says. True story. I heard they win all the time. I'll just go next time.
Yeah. Here we are.
They haven't won. So that has been a
60
valuable
years.
lesson. If you have the opportunity to go see something, a concert, a good Raptors game, a TFC game, anything that you think is good, just go.
That's why I
Enjoy the
always hear
moment.
didn't you go to the Raptor parade?
Yeah.
Yeah,
At
and-
the beginning, at CNE, before the gates, before it went out, we went, we saw everybody.
Yeah.
Drake was on there too. Everybody's there. Carol and I are like waving. And then we went home. We didn't realize the parade barely got started because it was madness. We went and had lunch in downtown Oakville and they hadn't left yet.
Yeah,
And
that's
people were there we had friends there for like, I think 18 hours it felt like, that couldn't use the washroom because they were going to miss it. But we got off at Exhibition. We walked behind Princess Gates and the buses were all loading up. We waved to everybody.
You're like,
and we
okay,
just
perfect.
left. I think somebody sprayed champagne all over us. Ibaka. He was spraying champagne. I'm like, okay, Carol, I'm done. I've seen enough.
Mufasa
And,
chef. He's
but
got
that
a
was-
good YouTube channel.
Does he still have that going?
I think so, doesn't he?
I don't know.
Cooks like weird food for
It
his
was good,
players.
though.
Were you at the parade too?
No, I'm not a big crowd kind of guy. I went to the Bills game this year, the Chiefs-Bills playoff game. That was great. That was like the
You went.
I did. I was there for that. I saw it in person.
You saw his Mahomes, your idol's first road victory in
I
the
did.
playoffs.
That's like the kind of crowd, but like to go downtown to a parade like that, like that's anxiety for me. I wouldn't want to do that. I'd rather work.
yeah.
I'll go work on mortgages.
Yeah. Thanks, guys.
Thanks, Tom.
Thanks, Tom.
Hey, thanks for tuning in. You can find every new episode of the Your Life, Your Term show on all the major streaming platforms. So Spotify, iTunes, Google Play. And if you'd like to get free copies of some of the books that we've put together, like these right here, or some of the reports that we've put together, like these right here, you can find all of those at www.rockstarinnercircle.com. That's www.rockstarinnercircle.com. www.rockstarinnercircle.com. That's it for now. Until next time, your life, your terms.